The biggest risk that we've seen is liquidity, secondary market liquidity. So the pressure that a lot of asset managers have had over the past few months is, one, you can analyze the fundamentals in a rock solid way, but with the secondary market volatility that you find, the mark-to-market risks are such that you're, I guess the way to put it would be, when you're market to market, because of the secondary market volatility, the perception of risk because of the price movements has been pretty extraordinary in the past few months. And what jumps out with many of the Middle Eastern credits is the markets, while there may be the same kind of lack of depth on the bid offer, the marks don't move the same way. So if you take a look at the relative performance, actually in the past couple months, the Middle East has outperformed Latin America, but especially when you start taking a look at a risk-adjusted return. The sort of weekly marks, you just don't see the kind of volatility. So, as a point of reference, in some of the meltdowns in December, January, when you would find Latin American credits or even issues as big as Greek bonds would be trading with 5-point swings, it was unusual to see Middle Eastern credits getting much more than 2 points movement in a day. So in terms of risk by market movement compared to fundamentals, you can be a little bit more confident that your fundamental analysis will bear out in the secondary prices. So if something is deteriorating, the sell-off is going to happen over a few months as opposed to in one day and then recover and go back and forth. So it allows for a little bit more of a measured investment process. Yes and no. I mean, the liquidity squeeze because of the oil, price drop, it was pretty extreme, and there seemed to be more cracks. I mean, I don't think things fell apart nearly as quickly here as they did in Latin America. So, one would have expected more opportunities, but because there's, I don't know if there's more capital backing, some of the companies because they're related to the governments, or maybe people are just more thoughtful. You haven't seen nearly as many distressed opportunities here as you have seen in Brazil, Colombia. We're involved in a workout there. So the answer is yes, but it would have been nice to have seen more. And given the fact that oil prices are recovering slowly, or certainly off the bottom, you don't see quite as many cracks. The real opportunities have much more to do with the U.S. sanctions than with the conditions on the ground. The biggest risks within Iran are sort of the struggle for political power. So, this whole process of, if they're going to reintegrate with the international community, how do the hardliners fit into this? One would expect that a number of them are doing everything they can to hold back the reintegration, but it seems to be happening. So you'll probably find that some sort of compromise, some elements of the hardliners will, assert themselves in the corporate side. The opportunities there are probably more broad-based than anywhere else in the region. It's if you look at it in terms of their potential export revenues, oil at most is about 40%. You'd expect that to drop as their productive capacity, manufacturing capacity kicks in. In terms of trade, it's a huge potential opportunity. I mean, if you look at potential U.S. exports to Iran, given their domestic demand, especially for U.S. goods, you could easily rival the exports of the U.S. to Saudi, and Saudi is very concentrated on, defense. It's an incredibly diversified economy. It's not just one commodity. There are a number of other commodities, but not just hard commodities, potential soft commodity exports. And you've got, a potentially dynamic financial sector that's been, cut off from the international payment system for a number of years. The banks there need reform. But you've got a very well-established middle class. This is not a, third world story. It's a, relatively developed country looking to reintegrate. So the turnaround when the sanctions get clarified will happen very quickly. And the impressive thing is how, despite a lot of the international rhetoric, that the process has taken on a life of its own. So to some extent, this is happening, and people can choose to get on the train or not, but it's left the station, probably won't stop. I mean, what do the downgrades do to? It's dropping oil prices. I mean, any kind of the structural imbalances that you point to only become evident when the revenue stream is impacted. So, I mean, I don't want to be too simplistic, and there are many stories, and I'm not a GCC specialist by any means, but my simplistic view on a lot of this is clearly many of the credit situations can be sustainable in low oil prices for a long time. There's a tremendous amount of wealth here, but honestly, if in terms of the pressures, the real pressures are going to be determined quite a bit by oil prices. And I think that one of the things, I mean, we seem to have bounced off the bottom, but one thing I'd sort of point out, and this relates to many oil-producing countries, globally, is it's one thing to have weak prices, but what was really creating a lot of impact, over the past, year was incredibly volatile prices. So it made it impossible to plan constructively. And what you're seeing now is, it seems like we found a bottom, and the price movements aren't nearly as, they don't move nearly as dynamically. So, I mean, the point, coming out of the Doha talks, one would think that that would have set the stage for an abrupt sell-off. We didn't see that. So that's pretty constructive. So I think, to some extent, it might be a bit too optimistic to reform a lot of the structural issues, but as long as the revenue, stream looks constructive, I think you can be comfortable with the credits.